Hey everyone, episode 2 with Jonathan Twanley. How you doing, sir?
I'm doing great. How are you, Michael?
I'm doing good, man. This is the one I've been looking forward to since last week when we teased it, right? We were looking at December rent collections. We were both kind of like, kind of feel soft, but there was a weekend. What's going on? December historically is always a little bit soft. So I've seen some significant drops in my personal portfolio, but I'm curious on the bigger scale, what are you seeing across the country?
Yeah, so usually this is tracked by NMHC. They have their rent collections tracker for a reason that I don't really understand. They're not collecting the data for this past week, or they didn't release it. They're not releasing it until the 20th. But RealPage, so the way that the NMHC tracks its rents is by aggregating data from four major software platforms. So
Okay.
there's like Yardi Matrix and RealPage and a couple of others. Uh, RealPage came out and just released its own data, right? Because NMHC didn't do the aggregate this week. And RealPage said, well, based on our data, collections are off by about, I think it's 4%. Let me get the actual um, numbers here. So just bear with me for a second.
Yeah.
So they are off by 4.2% compared to last year at this time through the 13th,
Yeah.
and 2.5% off of last month. So this is now it's through the 13th of the month, so it eliminates that weekend sort of glitch in the data that we thought could be possible. Again, it's not the best data because it's only relying on one of these software platforms, not all four of them. So we could take that as a grain of salt. Also,
Yeah.
however, I think it's a big enough sample. RealPage is a big company. It's a big enough sample size that I think that it will probably see this in the other software platforms as well. So I think what is now happening is that, that additional stimulus that people were getting that ended several months ago, but people probably banked that money because they got so much of it, but B, they also were like, hey, times are uncertain. And now we're seeing it actually starting to, people have now spent that money. There hasn't been any additional money forthcoming. We've also seen, I don't know if you caught this, but apparently, 90% of PPP recipients have now exhausted those funds.
I saw
Right.
that. Yeah.
So that I'm sure is having an effect on this as well. So this is kind of, it's delayed again. As I always say, one month doesn't make a trend, but it's not good data, right? It's
Yeah,
not.
it's so I put out a note. I think I put a note out. So we talked Thursday. So I think it was Saturday. So it would have been, I think it would have been the 10th. Or what day is it today? Yeah, it would have been the 10th. Because that was enough for me to look at my own collection. So we were down March to November about 1.5%, basically a unit or two in our portfolio, which is much better than I expected when I had that freak out on Sunday and called my property manager and audited my entire portfolio. December is a very different story. We're down mid double digits, significant. December's always a little soft, right? It's always the worst month, right? Where people go, hey, I'll buy Christmas, but I'll pay it off in January, that kind of stuff.
Right.
But this is different. My property management organization, it's down double digits across their portfolio. Wow. And then because I put out that note on the 10th, I've heard from property managers and other owners from across the country, and it's definitely down, right? I didn't bother asking class because class isn't interesting to me, but everybody, it's funny. Anybody that has apartments is reporting down. I had a couple of people that own just homes. I think one was like 20 single family homes and one person owned 55 single family homes. They're reporting no problems, which is interesting. It's the same in my portfolio. I have the same single family home that's been a problem since March, but all my new pain is in multifamily.
Yeah.
It's just interesting.
I don't know the data at all on this, and it'd be interesting to look at. But given the fact that single family homes rent for more, right, because they're bigger than apartments generally, right? Probably the people who rent them are a little bit more better off, and
maybe
they're tend more to be in those jobs that that where you can work from home. And probably, I would imagine, a lot of what we've been seeing, right, is for this trend of people seeking more space
Mhm.
and buying homes. But I'm sure there must be some percentage of people who are not in a position to buy a home or don't want to commit to buying a home, but still want more space and have moved into a single family rental
Oh yeah, single
instead
family
of,
rentals are on
yeah.
fire, just on fire right now. And the other thing, because again, I've owned these for 20 years and I've been through a couple of recessions on single family homes. People fight to stay in single family homes, right? If they lose their job,
Oh,
what they typically do, again, maybe it's only my market, but I'm sure it's across the country. They invite their sister, they invite their neighbor, they house hack,
right,
right?
right,
They ask another family member to come in and pitch in. Because again, once you're in a house, once you go from apartment to house, even as a renter, the last thing you want to do is go back.
right.
So people fight tooth and nail, at least what I have seen. And I
Yeah,
think that's key.
and if you have, and it's a lot easier, to rent out a room in a house or give somebody a room in a house, right? Or the
Yeah.
basement, or there's just
Or the
more space.
garage or
Or yeah,
whatever. Yeah.
whatever it is, there's just more space in a house that you can do that with and invite that friend in, or um, you know, and
Yeah.
chances are, that friend is also coming from an apartment rental someplace, right? So
Mhm.
it just as, everyone. Now we're going to talk about what's happening in C-class rentals also in a minute, but
Yeah.
there's been this this argument for quite a while. And frankly, I'm sure that this is Grant Cardone's doing, but this idea that rentals somehow perform better in recessions because they're cheaper and because people got to live someplace. And people got to live someplace. They absolutely do. People have to live somewhere, but that somewhere may be in that unused third bedroom in your sister's house,
Exactly.
right?
Mhm.
It may be in your car. It may be under a bridge,
Yeah.
right? It may be like moving back home with your parents. It
For
doesn't
sure.
mean that having to live somewhere doesn't mean going and renting a C-class property. And frankly, I have nothing to prove this with, but I would be willing to bet that there is a certain percentage of the population that, say, is renting, A or B class property, right?
Mhm.
Who would never move to a C class property ever, right?
For sure.
Right? They will move in with mom and dad or whatever, or their friends,
Mhm.
before they would ever move into a C class property, no matter how cheap it is,
Agreed.
because those are really different classes of property. There's a different demographic. There's a different status to it.
Mhm.
So the idea that it's all about like how much rent you pay is really ludicrous.
Yeah.
Like, now you think about, like, for most people who are like professionals, maybe they lived in they would have lived in a C class type property when they were in college, right? Or when they were in graduate school, because that was all they could afford and they wanted to have their own apartment. Once you once you're out there,
It's the same as the
practicing
house. Yeah.
law,
You don't want to go
you're
back.
out, yeah, once you're out there practicing law and you've been living in the class A apartment, you know, you could lose your job and be out of work for 6 months. You're never moving back into that class C property in the bad
Mhm.
neighborhood, right?
Yeah.
You're going to just find some friend to move in with or go home or
Yeah. You'll
whatever
couch
it
surf
is.
for a while. Yeah.
Yeah. So this
Yep.
whole idea that it's all about how much dollars are charged for rent. I've never bought this argument. I
Yeah.
just,
So as the one person on this that has C class apartments, which I've
yeah,
been clear I have, this is what I see in them. Really it's about payment source. So first and
right,
foremost, C class is often where Section 8 housing is. It's in a
right,
little bit of the lower Bs, but mainly the supply is C class. Could be nice, but still C class. Rent collections, as you would expect, Section 8 unaffected, right?
right.
So if you're in C class and you're government housing or Section 8 or whatever you want to call it, you are doing quite well in this crisis because the money's been guaranteed and it's shown up every month. And I'm sure it will continue to. In fact, I think it will get bigger. The program gets bigger next year. But if you have cash paying tenants, which I don't know, I guess 40% of my C class apartments are cash paying, that's where the pain is, right? Those were the
Yep.
dishwashers or the retail clerk or whatever. And they've had a problem.
Yeah.
And the money they
And
saved is banked, it's gone.
and it's not, and so there's a lot of people out there who want to say, and particularly sort of the people who just hate government
Hmm.
and think it should be abolished, right? And we just shouldn't have a government at all. All those types are like, well, this is all because of the government, and as soon as the government stops shutting things down, all those Class C tenants will be fine. It is not just because that is the cause of this particular recession, maybe,
Hmm.
right? But this happens in every recession when it's just a business cycle recession. And I can show you the statistics from Greenville, South Carolina, about vacancy rates going to 17% in Greenville, South Carolina, which is a great market, which I love,
Hmm.
right? During the great financial crisis. And it's because when companies have to cut, who and they possibly can. The people that they're going to cut are, you know, the servers, the cashiers, the stock boys,
Hmm.
all those things. They'll just load up the people who are there with more work, try to extract more work from them,
Yeah.
uh, and fire as many people as they can. And those are the people who are renting in Class C.
Yeah.
When I owned my Class C properties, and what I owned was Class C that was full market rate, so
Hmm.
no subsidies at all, right?
Okay.
And so I knew the profiles of the people who worked there. They were service workers and some factory workers, right?
Okay.
Those are the people who were the first in line to get cut when when the economy goes south. So the whole idea that somehow you're going to then like replace those people very quickly with people of a higher status,
Yeah.
you know, it just doesn't happen, and the facts don't bear it out. And if you go and talk with professional property managers who have been around long enough, they'll tell you, yeah, it gets pretty tough in Class C
Hmm.
when, you know, when the recession hits. And then, what else happens is your Class B, which has nicer apartments in better neighborhoods, they're feeling the pain. They start offering concessions and creaming off the best of the Class C tenants,
Correct.
right? So just like A is trying to cream off the best of the Class B tenants,
Yeah.
right? So it, it
Yeah,
yeah,
this cycle is going to be painful for multifamily. It's
yeah.
not going to be the safe haven that it was in the Great Recession. And,
Well, but
and
the thing is, but that's a misnomer too. It wasn't a safe haven in the Great Recession. It,
true, people
it
believe it to have
yeah,
been a safe haven.
it exploded after the recession
Correct.
in the foreclosure crisis, which happened later,
Correct.
right? But during the recession itself, it did not do well. And as a matter of fact, you know, as I've said numerous times, multifamily did better than all the other asset classes because it only lost 33% of its value,
Yeah.
right?
Yeah.
As compared to every other asset class, which lost even more of its value,
Yeah.
right? So obviously, if you didn't have to sell or refinance during that time, you wrote it out, right? But the idea that we're going to see a repeat this time, we're not going to have a big foreclosure crisis
Mm-mm.
this time around. We're actually seeing the opposite, right? We're seeing the exact opposite. We're not seeing people getting kicked out of their homes. We're seeing homeownership rise right now,
Exactly.
right?
Which we've been
So
talking about for weeks.
right. So the idea that like multifamily is going to benefit from a bad economy
Yeah.
is just that was a didn't even happen the last time around, but the thing that did happen after the bad economy that really benefited multifamily is a non-repeatable event.
Totally
It
agree.
was a one-time event.
Yeah. So
So
rent. So the other thing we want to talk about in this episode is first off, we validate that rent collections are down
yeah,
A, B, and C. Worse in the C, next B, but even worse in the A. But here's another wrinkle that folks need to realize is rent prices are
are
down.
down. Rents are down too.
And my guess, or at least again, looking at my portfolio, is it's kind of the reverse. They're down the most in A,
Yeah.
next in B, and probably most places flat in C.
So there's actually some data that's come out again from RealPage
Okay.
on this question in the last week, which shows exactly what you said.
Oh, cool.
That A is taking a big hit as it always does because there's new supply in A and those people are leaving to buy houses.
Correct.
It's trickling down to B because A and B are related in that way. And now there's a lag, but the lag is it's starting to hit C now too.
Mhm.
And even in some of the markets that have been real, like golden boys of the multifamily market, like Austin, down 4%,
Oof.
right? Uh, Nashville, down a percent, right? So Raleigh Durham, down 1%. So it's not just now. Obviously, those markets are holding up better than say New York and San Francisco, right? By a
Yeah.
lot.
A lot. Yeah.
But don't believe that you're immune just because you're in the Sun Belt,
Yeah.
right?
Yeah.
So, and if you're underwriting rent growth right now,
No,
you're going to overpay for property.
for sure.
So, because rents have been flat in the places where they're not negative, they're basically flat as well. So, this is not time to be aggressive with your underwriting, even though frankly a lot of people are because they can't get assets without being aggressive.
People are just don't want to have cash. I mean, it's okay to have cash, people. I mean, just relax, take a breath. The deals will be coming.
Yeah.
I guess the last
It's
thing
just
I
like,
want, go ahead.
yeah. No, I was just gonna say just on that point. I mean, another great thing in like Seeking Alpha, there was a good article on asset bubbles today,
Mm.
and the author of that article made a point which I always make, which is if you don't like, yeah, your net worth is really high right now because of the bubble, but if you don't liquidate some of it,
Yeah.
right, then two things happen. You you know, when the crash happens, not only will you just lose that will just go poof,
Oof.
but then you won't have the cash on the side to take advantage of all the bargains, right?
Totally
And
agree.
you have to have that dry powder to take advantage of bargains. And the greatest investors in the world always have that. That's why they're the greatest investors in the world, because they have the dry powder.
Mhm.
It's all about when you buy.
Yeah.
Real estate, Bitcoin, whatever it is, it matters when you buy it. So
So the last thing I want to say on this topic as we wrap it up is I'm going back to those syndicators, right? We all know, or many of them stopped paying because they got nervous in March, April, which was the right thing to do, right? Because
yeah,
we don't
absolutely.
know. Totally get it.
Preserve
Many
cash.
of them have started paying since. I wonder, because all these numbers are getting bad, kind of like what we expected in March and April. When do they send the notice that says, hey, we're not paying our preferred return this month or this quarter or whatever their duration is? I have to imagine that's right around the corner because again, vacancies, evictions, rent's falling. It can't be good for their numbers.
If rent collections really, if this continues for another month, then you'll see it.
Okay.
Because if, I mean, look, a 4% decrease in collections, which is what we've seen, and maybe more in C's,
Mm-hmm. For sure.
that assuming that you're at a 50% expense ratio, that's an 8% decline in your NOI, right?
Oh, yeah.
But the thing is that it's very difficult to cut expenses on multifamily, right?
Yeah.
Right. You can't cut your property taxes. You can't cut your insurance costs. You can't really cut the labor on the property. You could maybe try to reduce some hours, but I mean, you can't really do it.
Mm-hmm.
You can't reduce there's no way to reduce your utility bills.
Mm-hmm.
So, and your debt service is not going to change either.
Yep.
So it all drops straight, that decline drops straight to your bottom line. Right. And, that hits everything. So if this continues for another month, I think you're going to see a lot of that. Just people not being able to pay the pref. And again, as always, it's going to depend on when that deal was purchased. If that
Absolutely.
deal was bought in 2015, you're probably fine, because you're probably actually at this point, if you bought it that early, they were probably paying way more than the pref anyway. Right?
Probably. Yeah.
So there's a lot of cushion between what you're getting and the preferred return.
Okay.
But if they bought it in 2019, with the debt service that's attached to that.
Yeah, for me, again, you're far more the expert in this, but I keep thinking anything that's a 2018 vintage that was value add, hold the IO period and all that.
Yep.
I'm like, anything 2018 and on is something I would at least be worried about.
Yeah, and look, I wonder what's going to happen, whether the banks are going to basically kind of invent a form of forbearance, which is essentially, we're just going to extend your IO.
Yeah, extend and pretend again. Yeah.
Yeah, I mean, but not even that. Just they'll just say, hey, just keep on making your interest payments and you won't amortize the loan, and then it'll just be a balloon at the end.
Yeah.
But that's,
I don't know. I think the banks are going to do what they always do, is they're going to take this opportunity to evaluate the provider, right? The person, and the ones that they deem shaky, they're going to wash them out. They're not even going to have second thoughts. And then
I agree with that. I mean, they'll take advantage of the situation
for sure
to get rid of people who they don't think are
weak hands.
Yeah, but I think for the assets and the operators that they have
Correct.
faith in, they may just say, we're just gonna, because I mean, if they could make, if you have a loan that's not performing and you could make it performing simply by extending the IO,
yeah,
you do that rather than foreclose. Why would you foreclose?
No question.
You don't want to do that. So.
Very, very cool. This has been a fun conversation. Again, folks, I think it gets worse from here. Rent collections down, rents are down. Be very concerned if you're an LP in a 2018 vintage. Maybe call your operator and have some discussions, because one more month of this might be a problem. So thanks, Jonathan.
Absolutely.
Thanks.